Hi guys, welcome to today's session. In this session, we're going to go over a Darwin, what a Darwin is, and how having a Darwin can benefit you as a trader. Now, I appreciate a lot of the language used in this session is going to seem like jargon at first, but please just stick with me. I'm sure as we go through the session, things will start to make a little bit more sense. And if you do have a question, please just let me know. Put it in the chat, in the Discord, X, Instagram, or YouTube chat, whatever social media channel that you're watching this session on. Just stick any questions in there and I'll either go over them at the end, or if it's relevant to what I'm talking about at the time, I'll stop the session and I'll answer any questions that you guys may have. Now, if you've been to these sessions before, you'll know what to expect. However, this is our more in-depth weekly session where we look at Darwin, we look at Darwinex risk, the value at risk, and we see how your risk exposure affects your trading strategy. My name's Kieran and I'm head of UK growth and business development for Darwinex in the UK and English native speaking countries. And Darwinex is a regulated asset manager and broker. We hold regulation in 3 separate jurisdictions: by the FCA in the UK, by the CNMV in Spain, and also by the FSA in the Seychelles. We currently have over 100 million US dollars invested in our platform from third-party capital. And I need to update this presentation, but we actually have over 11,000 active strategies in both Darwinex and Darwinex Zero running concurrently right now. And our only job as a business is to connect good traders with investors and to invest our own capital in our good traders. That's what we're doing with everybody. We have 100% aligned interests and we want to see all of our traders succeed long term. Now, you might be asking, what is the point of a Darwin, or even what is a Darwin? So to begin, a Darwin is just a risk-adjusted version of your trading strategy. This is a benefit to you as a trader because you will learn so much more about your risk exposure as a trader just by having a third party look at it, give it a score, and basically tell you, which is, again, Darwinex's job, and basically tell you what notional value exposure that you have on any given trading day or trade. I'm just going to open my window because it's about 400 degrees in this room right now. The second reason every trader needs a Darwin is because you come under Darwinex's regulatory compliance. Now, if you aren't already aware, which every trader should be, to manage capital from an investor, you need to be regulated, or at least depending on where you're based in the world. In the UK, we're regulated by the FCA, and you have to be a regulated body to manage capital on behalf of an investor. Now, having a Darwin, which is where the risk is managed by us as a company, it allows you to operate under Darwinex's regulatory compliance and under our licensing, so that you don't have to necessarily go out and get your own license or qualifications or any of that. It's extremely expensive. To get regulated as an asset manager, you have to lock up a significant amount of capital just to prove that you're liquid, and you have to jump through leaps and bounds and hoops. And at the end of the day, they can always turn around and tell you, no, you don't meet the requirements, or we just don't want you as an asset manager. Again, trading through Darwinex or Darwinex Zero gets rid of that hassle because you come under our license. And last but not least, you get a proven track record from a regulated broker. Now, why is that important? Of course, if you want to be a professional trader, you want to take on investment, or maybe you want to go and work for a hedge fund or a prop desk, wherever it may be, having a track record is key. But that goes a little bit deeper. There's having a track record, but there's having a track record and a risk-adjusted track record from a reputable regulated broker. There's no point in having one from a 1-star out of 10 broker that's based in, I don't know, some weird country with no regulation and there's 2 members of staff. Is a track record from them going to really hold up to a prop firm or to a hedge fund who's looking to allocate 10 million? Probably not. Is one from a regulated entity going to hold up? Most likely. Or at least the hedge funds that I've spoken to and worked with in the past, Darwinex has a very reputable name. Now, that being said, when you start your trading journey with Darwinex and Darwinex Zero, your statistics that are shown to you from your Darwin are going to differ from what you would see on your MetaTrader, or what we call your Signal account. And the reason for that is because we have our proprietary risk engine that risk adjusts all of your position sizing at Darwin level. So depending on your risk exposure as a trader, you might be tuned down or you might be tuned up, but it's very, very rarely going to be one-to-one. And what I mean by one-to-one is if you're trading a 10 lot on your MetaTrader account, your Darwin is unlikely to also be trading a 10 lot. So our proprietary risk engine adjust all of the traders' trade size on our platform. So all 11,000 strategies that I mentioned at the beginning to maintain a value at risk, or VAR or VAR, as you know, the terminology might get thrown around within Darwinex, of around 6.5% per month across the board. Value at risk estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, again, I know that's probably a little bit when it comes to the terminology and the way that sentence is phrased. So we've put an example in just to help you understand what that actually means. So for example, if a trader has a value at risk of $1,000 or 6.5% in this example, with a 95% confidence level over 1 month, it means that there's a 95% chance that that trader isn't going to lose more than $1,000 or 6.5% in any given month. This is important because if we're taking on investor capital, the investors need to know what their maximum downside is. And we can't guarantee, 100% because we're in markets, black swan events happen, there's no guarantees. But we can say within a 95% confidence level that this should be your worst or your maximum drawdown within a single period of time. Again, that's not to say that you're not going to have multiple months where you're losing money. We're not saying that. We're not promising returns. But if we can mitigate the downside for investors, then fantastic, because the investor can feel safe knowing that their capital is being watched by the risk engine, which is akin to having a risk manager. So if you were working at a hedge fund or a prop desk or investment bank, any of these professional institutions, you would have multiple members of staff watching over your trading. So you might have a head trader who's, watching your progress, looking at your positions. You'll have a risk manager who's more akin to the risk engine, who watches your notional exposure, who looks at your trade sizes, who understands when you're overexposed, but also understands when you're underexposed and you need to put your foot on the gas, because the risk engine does that too, which not a lot of people are aware of. So if you trade with too small size and you're under the value at risk of what we deem to be the same as the S&P, which is 6.5%, the risk engine might scale your size up. So it works both sides of the coin. So by the risk engine doing this, what it does is it creates a level playing field, ensuring that every trader on our platform is judged based on their skill and not just the amount of risk that they're willing to take or by luck. Every trader has basically the same running shoes on, right? Is the easiest way I can think of it. Every trader has the same running shoes. Who can run the furthest is based on their skill. Okay, there's no cheat code, there's no free ride. It's all about your skill, because you're all operating with the same amount of risk. Now, if you can generate a higher return than somebody else using the same amount of risk over an extended period of time, that would therefore generally make you a better trader, right? If you can't beat the S&P or the return of the S&P whilst using the same risk, again, is there much point in an investor allocating capital to you when they could allocate their capital to the S&P and have less drawdown, more return? So your first benchmark is always going to be beat the S&P from a returns perspective. Be non-directional buyers. So of course the S&P is based on the market going up. So if you're in a bear market, of course the return of the S&P is going to be diminished. If you can provide better risk-adjusted returns and have less drawdown periods and be non-directional biased, so you don't necessarily need the market to be booming to make money, then you've already ticked off the first box. And that then brings you to the second layer, which is beating your peers. If you can outperform other traders using the same risk, you're going to be in the top 1% of traders globally, worldwide, however you want to say it. Now, I've already touched on this, but why do we use 6.5% value at risk? Well, to put it plainly, 6.5% VAR is the S&P 500's risk level. So that is the value at risk that the S&P operates at. Now, we know that investors are familiar with the S&P, they're happy with that risk level, and they will sit through drawdowns, and they will sit and happily leave their capital to do its thing in the S&P. So we're trying to match that. So by adjusting your strategy to a risk level that ensures it meets investors' expectations and risk tolerance. Because again, the S&P has been around for donkey's years, and we know that investors will sit through it, even through the bad times, because they see the end goal, they see the long-term wealth generation. Going back to what I mentioned, this is a screenshot of your Darwinex Zero dashboard, and the statistics that are shown on here are the risk-adjusted version, so the Darwin statistics. You can view your Signal account statistics by clicking the grayed out option on the screen, which says Signal account with a little locked icon. However, only you can view those metrics. We don't show your IP or your Signal account statistics to other people. We only show your Darwin return unless you choose to opt in. So for example, on Darwinex.com, you can hide your Signal account statistics, or you can choose to show people. It doesn't really matter. It doesn't matter to us. But if you want that information protected, it stays protected. But by default on Darwinex Zero, your Signal account statistics are private to you and you only. Now let's talk about VAR in a little bit more detail. So this is a screenshot of your VAR chart. So this measures your VAR in real time and it updates in real time. So it's a dynamic chart. We stuck a nice fat white line on saying 6.5% just so that you can see where the standard is, which is where the risk engine is going to be targeting your risk. At the beginning of the chart, it looks like the trader's probably about 2x of 6.5%. So they're probably roughly sat somewhere around 13.5% at that point. What the risk engine is going to be doing is it's going to be trying to mirror their trade size to become 6.5%. So it's going to cut it in half. So if this trader is operating with a 13% value at risk at Signal account level, to get to 6.5%, the risk engine is going to slash the position size in half. So if the trader's taking a 10 lot on their Signal account, their Darwin might be taking a 5 lot position. Now, what this means is their return is going to be lower, yes, but also their drawdown is going to be lower. So it's just giving you a better risk-adjusted return, or at least a different risk-adjusted return. Now, as I mentioned, this is a dynamic chart, and as it drops, your risk multiplier, which is the second metric that goes hand in hand with your value at risk, and it's kind of a balancing mechanism like on a seesaw. As your VAR increases, your risk multiplier will decrease, and as your VAR decreases, your risk multiplier will increase. Now, as this chart moves slowly down to 6.5%, the trader's risk multiplier is going to be increasing to eventually where they come to a 1-to-1 level. As the trader's VAR hits 6.5% at Signal account level, pretty much their trade size is going to be replicated for 1-for-1. So if the trader's taking a 5 lot at this point, the Darwin is also going to be taking a 5 lot position. As the trader moves under 6.5%, the risk engine is actually going to start flipping this on its head, and it's going to start increasing the trade size at Darwin level. So as it moves down, let's say the trader's taking a 1 lot or a 2 lot. If this trader gets to 3.25%, the risk engine's pretty much going to be doubling their risk. Not exactly, but pretty much there or thereabout. So for every 1 lot the trader takes, the risk engine might be taking a 2 lot on the Darwin. And again, this is dynamic. It will update over time, and it has a 45-day look back period. So it looks back at your previous 45 trading days, and it will compare it to a 6-month average. If you don't have one, it will use the data that it has to make sure that you're not being over or under leveraged. You'll also see this on your own Darwinex dashboard. You won't see other traders because, again, this is private because it does show your live trades. So it shows any positions that you're currently in. It shows you your Darwinex risk. So this is the risk multiplier that I was on about. So you can see for this trader, they're being scaled up. So for every 1 lot that the trader is taking at Signal account level, their Darwin is trading 2.32 lots. The current closure rate shows how much of the position that the risk engine has closed. Now, the risk engine can close certain amounts of your position. It can do it. It doesn't do it often, but what it does is it measures your deleverage, which I'm not going to get into now. I've done some short form content. It's on our Instagram, TikTok, YouTube, Twitter or X, Discord. It's everywhere. I would recommend, if you don't know what deleverage is or any of the stuff that I'm talking about, I would recommend going and watching these videos because I put a lot of work into trying to make these concepts as easy to digest as possible. And rather than me try and explain them all now, there's 30 to 60-second videos. There's loads of them, and it would massively benefit you just watching them and understanding these concepts in more detail. But basically, the current closure rate, we measure your deleverage. When that expands out of what is kind of the allowed deleverage for a specific time frame, the risk engine might go, okay, well, this trader's notional exposure has now gone up. It's now increased. So what we need to do is we need to close part of the position. So it might only close 5%, 10%, 20% of the position. What we see here is grid traders, martingalers, they get high closure rate. And therefore, it flips the system on their head because they're leaving their exposure to get worse and worse and worse. And the risk engine will begin closing trades early, or at least closing some portion of these trades early whilst it's in drawdown. So whilst a martingale is waiting for the whole trade to turn around and take a profit, the risk engine might be closing some of those trades in a loss. So it's something to be aware of. And then underneath those two boxes, it shows you any of the trades that you're in. So you can see this trade is in a New Zealand yen sell or short trade. They've got 1.2 contracts or lots open, and the Darwin is in 2.79 lots because of the 2.32 risk multiplier. Now, we do this to ensure fairness and consistency amongst every single trader that comes to Darwinex or Darwinex Zero. So if we take an example where we have two traders, we have trader A who trades with too much risk, so they trade with too high of a lot size, and we have trader B who is the complete opposite, trades with not enough risk and they trade with too small of a lot size. The risk engine is going to be approaching these traders in the same but completely different way. The same way in terms of it's going to try and scale both traders to a 6.5% value at risk, but in a different way because trader A, it's going to tune the risk down. Trader B, it's going to tune the risk up, bringing them to a level playing field. So even though it's signal account level or MetaTrader level, trader A might have made an exponentially larger return due to betting larger size. They may also have a much larger drawdown than trader B because of trading larger size. At Darwin level, it's completely fair and they are operating with the same level of risk. Again, ensuring that people or traders or our traders specifically are judged based on their skill, not just luck. And again, it comes to your Darwin, which is our standard risk level, a 6.5% value at risk, which I think it's important to mention at this point is that investors can leverage up their investment. So let's say I put $10,000 into a Darwin. That $10,000 goes in at 6.5%. I could leverage that up 2 to 3 times, and that would mean my value at risk increase from 6.5 to 13 or to 20%, for example, because I would be leveraging up my capital. So as a standard, it's 6.5%, but it can be increased. And we did back in the day, we used to have a higher threshold for value at risk, but what we found over time is that we had to fine tune it to keep investors happy. Because if our investors are happy, the traders are happy. If the traders are happy, Darwinex is happy. What we don't want is investors to come into your strategy, allocate capital, and you go through a drawdown period, and because they're overexposed, they lose too much money or they're in an unrealized loss, they close, they pull their funds. It doesn't benefit the investor because they have a huge realized loss. It doesn't benefit the trader because they lose the AUM that they have, and it doesn't benefit Darwinex because our traders and our investors aren't happy. Now, I'm just going to check the Instagram chat because the past few sessions, I've ended the session and there's been a few comments. Today there hasn't been, which is fine. But what I didn't want to do is end the session in a moment and, have loads of questions unanswered. So that's something that I'm trying to be more mindful of moving forward. But back to the presentation, your strategy's value at risk depends mainly on 4 factors. However, there is one that kind of edges it in importance, in my opinion, which I'll cover now. So number 1 is asset volatility. So part of the equation is the volatility of the asset that you're trading. If you're trading something like Bitcoin, it's obviously more volatile than an asset like Euro dollar. Now, does that mean that you're a riskier trader? Of course not. But what it does mean is that there's more room for things to go wrong or for the market to be a little bit faster. And therefore it does bring more risk to the trading strategy or to the capital that's invested. Number 2 is trade frequency. So how many trades do you actually place? Are you in the market frequently or do you take 1 trade per week? Now, again, the more frequent that you're in the market does increase your value at risk. It doesn't mean that you're a risky trader. It doesn't mean that it's bad to be in the market more often than you're not. It's not saying that at all. But of course, market exposure brings higher risk. It's simple. The nature of the market is to be in the market, you have to take risk. Therefore, the more trades that you take, the higher your value at risk will become. And the same rule kind of applies for trade duration too. The longer that you're in the market, the higher your value at risk will be. Again, not to detriment swing traders or investors to say that it's bad to be in the market for a long period of time. It's really not. However, the more risk exposure you have, the higher the value at risk is going to be. Okay, so somebody who's in the market for 30 seconds has much less risk exposure than somebody who's in the market for 30 days. There's a lot that can go wrong in 30 days. There's not a lot that can go wrong in 30 seconds or 30 minutes. Now, the one that trumps them all, and the one that's kind of in your control without having to change your trading strategy, is your position size, which is number 4, and the final element to your strategy's VAR. And the reason I say it's a little bit different and the one that trumps the rest is because you could trade euro dollar or the lowest volatility asset. You could trade it once a year. Okay, so you're never in the market. You could hold that trade for 30 seconds again. So you've got 30 seconds a year of market exposure on the least volatile asset. But if you trade that with 5,000 contracts and per tick or per pip, you're risking 500 grand. Of course, your value at risk is going to be through the roof. And vice versa. You could trade Bitcoin or the highest volatile asset in the world. You could trade it once per second. You could hold those trades for a month. But if you're trading it with the smallest notional size that you can, again, your value at risk isn't going to be too high. So that's why I say your position sizing really is key in this equation, because all the rest are kind of baked into your strategy. Your strategy is based around how often you trade, how long you hold them, the assets that you trade. Your position sizing is something that can be changed and altered without having to actually physically change your trading strategy. And when it comes to your value at risk, the risk engine does all of this for you anyway. So when you're looking at your Darwin, a lot of people get obsessed with trying to get a one-to-one risk multiplier, meaning that for one lot they open a Signal account, they get one lot on their Darwin. But you end up chasing your tail because it doesn't really matter. The Darwin does it all for you anyway. The only time I would say you need to be concerned is if your value at risk is above 30%. If it's above 30%, what we've seen over the past 13 years after analyzing tens of thousands of different traders and different Darwins is that anything over 30%, there's cause for concern for either the account to eventually be blown or for the account to go through an extended period of drawdown. It's not saying it's going to happen to everybody. So if you're looking at it, panicking, going, well, I've got a 31% value at risk, that means I'm going to blow up. I'm not saying that. But what we see is after 30%, there's a huge increase in the likelihood of that trader blowing that account or going through a significant enough drawdown that scares investors away, scares a trader to ever trade that account again. So just be mindful of that. So this goes outside of Darwinex as well, right? And this is what I said at the beginning. It will teach you so much about your own trading and about your own ability as a trader. If you know that on a day-to-day basis, you're operating at such a high risk level, it doesn't matter so much with your Darwin because it gets risk adjusted anyway. But if you're trading your own personal account away from there, maybe you're trading for investors elsewhere through a hedge fund or what have you, or you're trading a prop account or funded account, you need to understand your exposure, because you can take it away from Darwinex and implement these things elsewhere as well, because you don't want to be trading your life savings with a ridiculously high value at risk. It doesn't make sense unless you're a gambler and you like the idea of maybe losing all your money one day. So that brings the session to an end, guys. Again, it's not too in-depth in terms of, I don't go through everything that's Darwinex related, but it's more of a deeper insight into your Darwin and the relationship between your Signal account and your Darwin and the risk and value at risk that comes with that. Now, I am going to be doing some work on these sessions over the coming weeks. So do expect them to change slightly. I want to make these sessions more flexible. I want to potentially, and actually this is a question to you guys as well. I put it out to the guys who were watching the session yesterday, but I'm going to ask all of you as well. So feel free to drop a comment in the comment section. I'll review them afterwards. But how would you feel about a Darwinex TV where there's a couple of live streams a week, maybe it's 2, 3, 4 hours, and through those live streams we do a presentation, then we then have some live trading, we then have some market commentary in terms of sitting down, listening to news, watching the market open, bring on traders, bring on some of our investors to come and talk to you guys. So a little bit just like, a couple of days a week, a little bit like a television series. Let me know how you feel about that rather than just fixed presentations every couple of days. I'm really trying to elevate what we're doing here and get the word out of Darwinex to as many people as possible, which brings me on to my next point. And I would ask all of you guys, if you have friends who are traders or you have a trading community, please spread the word. We do have our Discord, which currently has 9,930 traders in there. We're almost at 10,000. We literally need like 70 more. So if you like Darwinex, if you like what we do, please join the Discord for Darwinex Zero. It would be massively appreciated. We do have a partner program as well, allowing you guys to earn commission for your referrals for traders that you bring to Darwinex. There's some fun things coming in terms of building communities on Darwinex and having something that we call a tribe, which I won't go into today. But if you haven't heard about the tribes, it might be worth going on our YouTube and listening to some of our old sessions. But we will be able to reward you for bringing traders to Darwinex. And also, lastly, we have a member get member scheme, which allows any trader on our platform to bring their friends and family and earn a free month's trading with Darwinex Zero. So if you bring 12 friends after they paid for 2 months of the service, you will then get a year's free subscription to Darwinex Zero. So it benefits you by putting out the word about Darwinex Zero. And finally, we also have a 10% discount running, at the moment on all of our plans. So on our monthly plan, yearly plan, and 3-yearly plan, if you use the code Darwinex10 or DWX10, sorry, you will get 10% off your purchase. And also with the 3-year plan, you get a coupon code up to the value of €200 to put towards a permanent allocation as well. So not only do you get a discount from the 3-year plan being cheaper than if you was to buy it 3 times 1-year plan or 36 times a monthly plan, it's then got 10% off after that and the €200 coupon towards a permanent allocation. So finally, I just want to say thank you all for joining the session. I'm just going to check the Instagram once more to make sure I haven't missed any comments, because again, trying to be a little bit more inclusive of all the social media platforms that we're streaming on now. I think at the moment we're streaming on YouTube, X, Discord, Instagram. The only one we're missing is TikTok, but I don't think you can. Stream to TikTok. I'm not 100% sure. But guys, I don't think there's any comments. I can see a couple from YouTube. B said my QCNY, which I'm presuming is your Darwin, which I'll take a look at in a moment. And then Hansa said that's great. So I appreciate that feedback. But guys, I'm going to call it a session here. If you do have any further feedback for me in regards to the Darwinex TV stuff that I was talking about, Snowy, Rob, I don't know if you guys have any ideas for that. You're the ones who've been around these sessions more than others. So I'd appreciate, your thoughts or your feedback on that sort of stuff. But as always, my DMs are always open, and that goes to anybody. Feel free to direct message me or send me an email or whatever you want to talk about. I'm always here. Rob's just joined. No problem, dude. We'll have a chat on another day. That's no problem. But other than that, we will be back on Monday. I think it's bank holiday in Monday, so I probably won't be there for the session, although I'll be there to start it. But we'll have another, or at least the first session with Sanjeev, who's our in-house performance coach. He did a test session a few weeks ago, and it was received really well. So we'll be picking that back up from Monday. And then I will be back in on Tuesday for the welcome webinar. So guys, I hope you all have a fantastic end to your week and have a great weekend, and I will catch you all in the next one. Peace out.